I had a client today, came in, they've been a client for 2 years, and they were like, Jonathan, I'm firing my advisor up in Michigan. I was like, that's awesome. I was like, Karen, what sparked this?
Mm.
And she was like, I didn't want to talk to all these people. Like, I wanted to talk to one person. And you guys did a really good job with the portion I gave you to manage. And I was like, that's really good. She said, I've slept better in the last 4 days before I got here. We hadn't even had our meeting yet. Just whenever I made the decision, I'm going to move all my money here, the peace of mind that I felt was, I felt like a huge weight was off my shoulders.
Amazing. That's what we love to hear.
Yeah. And I mean, you're sitting up in the front of the office and you hear her talking to Mari and just like, she's got this positive, ultra positive outlook on where she's going. And I believe you can get there when you find the right person, when you believe in the right advisor and you invest with the right advisor. Welcome to the show. This is the Build Big, Live Bigger podcast. This is where you get real clarity about retirement so you can build a plan that blesses your life instead of becoming it. We'll share what you need to hear to replace worry with confidence, protect what you've built, and actually live your dreams, not your fears in retirement. Let's dive in. Hi, my name is Jonathan Burgess, and welcome to episode 27 of the Build Big, Live Bigger podcast. I'm joined today by my wonderful co-host, Luke Milani Grimes. Thanks for joining me, Luke.
Absolutely. Let's do it.
So today, what we're going to talk about is something that if you're watching this, you're probably interested in, and that's driving investment returns. And I want to talk about the common sense way to do it, where I have to say this for compliance reasons. Past performance is not a guarantee of future results. However, the way that I see investing in index funds it is not get rich quick. It's get rich for sure. Luke, I know we've talked about that before and how to use index funds. However, that is not a guarantee that index funds will get you rich.
Mm-hmm.
Please do your own investment research before investing in anything, as all investing involves risk. So that was my disclosure of the day. But I did want to talk about something that both Luke and I are passionate about, which is how do you increase investment returns for clients? And I think a lot of people spend so much time going on the internet, trying to research, trying to figure out vehicles to make more money. And a lot of times they can get shiny object syndrome. And one of the things in our world, especially for folks who have saved over $1 million, that could be shiny object syndrome is a hedge fund. So going into that, Luke, give me your best definition of a hedge fund.
Hedge funds. So when it comes to hedge funds, they're really a type of vehicle that you can invest in that usually there's a hedge fund manager and they will be actively trading in that hedge fund. And so when you buy into it, essentially you're buying into a vehicle that is buying into many different investments that's usually active. They're going to be buying and selling stocks, bonds, whatever it is.
Every day.
Yep. Oh, so quite frequently. And the strategies can differ, but yes, they're usually pretty active. And also, usually they come with pretty high fees as well because they're quite exclusive. They can be exclusive to very high net worth. And so, so those are the main things. The fees can be high. And usually, we hear of like the 2 and 20 fee structure.
Can you explain that?
2 and 20 fee structure. So typically a hedge fund, traditionally will charge 2% of the money that's in there.
So if you gave them $1 million, they would charge you $20,000 a year.
Exactly. And then if they produce any return with your money, they keep 20% of that return.
So if they turn the $1 million to $2 million, they keep 20% of the $1 million they made you.
Yep.
So you would pay $220,000.
Yep, exactly. So,
and that's if they did it in a year. If you were paying you pay the 2% every year, no matter what. So actually it'd be closer to $400,000.
Yeah, exactly. And so high fees, most of the time in general, you'll be overpaying for underperformance. You think that there's these, very talented investors and behind the helm, but often, a lot of the time they'll underperform because as we know, the average, the market itself usually beats out active management. So,
but why would someone go to a hedge fund? Like why not just invest in the regular market indexes?
So like you said, there is that shiny object syndrome. There is that allure of exclusivity. So number one, so often to invest in a hedge fund, with Ted Sides, for instance, which we talk about in the seminars.
Oh yeah, I'll go through that example.
Yeah. So like you'll have to have a huge amount of money to invest with them in the first place, maybe around $10 million for them to actually accept you into the fund. And then you'll be locked in for 5 to 10 years potentially as well, on top of the fees and likely on top of the underperformance. But anyway, so long story short, people get drawn in by that exclusivity.
Why do you think psychologically people want to make more? than the overall market. Like if I told you, hey, the market's going to average, let's say I had a crystal ball, which I don't. I have no idea what the market's going to do. But let's say I'm like, okay, over the next 10 years, the market's going to make 10% per year. Your money doubles every 7 years at 10% per year. Why would you want to make more than 10%?
Well, if you made more, it can compound your wealth a lot more powerfully. So if like you're making a 7% return, that doubles your money every 10 years. But if you're making a 10% return, you've doubled it in 7 years. So it's just much more powerful if you can have a higher rate of return. So that draws people in to the idea of outperforming. And so they'll look at these hedge fund managers and say, how have they done? And they may have a good track record or maybe not, but a lot of the time they'll get drawn in by that personality and potentially the idea of outperforming and the exclusivity too. So there's all these things that kind of combine that make people really want to, come in and have a chance of outperforming.
Mm-hmm. I think greed could be a portion of it. The market's driven by fear and greed.
Yeah, definitely.
And if you've saved, most of the people listening to this aren't 25, right? They're 50 and older. Mm-hmm. So if you're 50 and older, and you've saved enough money to qualify for some of these things, think about what it's going to take for you to live. Do you have to make 15% per year? Because why is it relevant for a retiree to be aware of the risks tied to active management?
Well, number one, if it is active, really you need to look at how they're investing, number one, because there could be quite high risks in how they're investing. Because if they're investing in options or very volatile stocks, like if you're just looking at return prospects, you may not be considering how wild of a ride that might be in the meantime. So if there's a huge wild ride and you have all of your money in there, especially as a retiree, as we know, again, if you have that market risk and it goes down, it crashes in the meantime, it may come back eventually, but as a retiree, you need to live on the money. Mm-hmm. And if you need to take it out, you're gonna run through that money a lot faster if it's crashed a lot.
Yeah, and the other thing too is in retirement, it's not about how much money you make, it's about how much money you keep. Mm-hmm. And I think about a client that you and I worked on, Randy, if you remember this. Randy comes in, he was a accredited investor. He had money all over the place. We got it consolidated for him. And this was back whenever you were doing pair planning still. So you weren't a lead advisor. You were building all the financial plans. And if you remember, Randy had saved over $1 million. I think he was around 1.5 or something like that. But he lost $75,000 in a hedge fund like investment. So it was a pooled investment vehicle for accredited investors. He lost the money. And do you remember how much, it wasn't about the 1.5 that he had saved. It was always about that 75,000, which was 5% of his net worth, by the way. But he was always like, man, those guys really got me. Man, those guys really got me. And every time he'd come in for a review, I'm like, Randy, we're doing great on this side. And we're talking about all the things that we're doing whenever we're in a 6-month review, annual review. But he still to this day brings up that hedge fund that he lost money in.
Yeah. And so many of these things are really unnecessary. You have many, many great investment options publicly traded in the stock market. So, there's it can be a big hassle going through private investments, and a lot of the time it may not be really getting you the return that you want. And obviously there can also be a lot more risk too, because anything in the stock market, I understand that game. I understand that there's regulations, there's reporting standards, there's a lot more behind investing in the stock market, and there's much more certainty of what you're getting into compared to something that's private.
Yeah. And two, you do have to ask yourself, what rate of return do I need to make to be comfortable? Because if you've saved, I don't know, let's say somebody's listening to this and they've saved $2 million. They only need to live on $100,000 a year. You are fine making 7 to 8% per year. And you're going to live a phenomenal life. But if you're at this age, let's say you're 60 and you're trying to make 15% per year compounded in a pooled investment vehicle where you have high fees, you have high risk, you don't have liquidity, and you lose 50%, and it takes this fund, 10 years to recover while you're pulling money out. Those losses can be detrimental as you're pulling money out.
Oh, yeah, definitely. And Also, definitely be aware when you're hearing about these private investment options that are, promising or saying that they're likely to make, 15, 20% returns. Be very cautious, because that's, it's really hard to do. And so really unrealistic too. So you need to definitely look a little bit deeper. So, I mean, that's why we have a team to actually verify good investments, like what are in the stock market, as opposed to going into something where you really may not know the game you're getting into.
Mm-hmm. Yep. So I do want to go over the story of Ted Sides and Warren Buffett. So if you haven't heard this story, what we'll do is we'll link it in the description of the podcast. But essentially what happened back in 2004 was Ted Sides was on stage at the Berkshire Hathaway annual conference. He walks up on the stage. He says, "Hey guys, if anybody wants to take on my investment philosophy over the course of 10 years, I'll bet you $1 million you can't beat me. So you can do whatever you want in the stock market, and I'm going to use a simple investment vehicle. I'm only going to buy it once. I'm not going to do anything with it. I'm not going to touch it. I'm going to leave it for 10 years. You can do whatever you want. You can be as active or passive as you want to be over the next 10 years. So he issued that bet in 2004, and there's a ton of people who attend the Berkshire conference, which, by the way, Luke actually attended. I mean, talk to me. How many people are at this conference?
There's about like 40,000 people in that arena. And
that's not a lot of people, Luke.
Right. It's the HCI Health Center in Omaha, Nebraska, and I've gone a couple times, and I plan to go every year. But going there, you meet some of the most incredible business minds. There's many fantastic and successful business people, investment managers, and investment enthusiasts. It's an incredible event to go to.
Awesome. So there's a lot of people in that room, though.
There's a lot of people in that room, and also a lot of very talented, successful people.
If retirement clarity matters to you, don't wait. Text BOOK to 864-920-3155 or click the link in the description below to get a free copy of Jonathan's book, Retire Right.
So when Warren issued the bet in 2004, nobody takes him up on it. He issues the bet again in 2005. Nobody takes him up on it. 2006, nobody until 2007. Somebody in the middle of the room stood up, and his name was Ted Sides. Now, Ted Sides, like Luke and I have been talking about risk with hedge funds, Ted Sides actually owned a hedge fund called Protege Partners. And so they were a fairly large hedge fund. They controlled a lot of assets for a lot of wealthy people. And he was like, "All right, Warren, I'll take you on. I think I can beat you, but I want to be able to buy 5 of the funds within Protege Partners. So I'm not putting all my money in one fund. I'm even going to diversify further." So these funds at Protege Partners were funds of funds, meaning that they bought 100 total hedge funds. So with his $1 million, he bought into 100 different hedge funds, which is essentially impossible to do. These allocations are very hard to get access to, and he had access to a type of hedge fund investment that only someone who was extremely wealthy and had more connections even than a wealthy person would have. And so they both start with $1 million in 2007, and obviously the crash happened in 2008. The bet goes all the way through the end of 2017. And at the end of 2017, Warren Buffett started with $1 million. Ted Sides started with $1 million. But at the end of the period, Warren Buffett had saved $1.85 million. So he had $1,850,000. He did not do anything with that investment other than buy it initially in 2007 and just hold on to it until 2017. Ted Sides, on the other hand, had 100 hedge funds. Of those, they all had different strategies. Those folks were buying and selling every day in a very volatile time in the market. And he only ended up with $1.22 million or $1,220,000 at the end of the 10-year period. So not only did Warren beat Ted Sides while he was using 100 hedge funds, he smoked Ted Sides
by around $600,000.
Yes. And what do we talk about all the time? You should always buy low-cost
index funds.
And the reason that we say that is index funds do not try to time the market. They try to be the market. So rather than trying to beat the market, you're trying to be the market. And they buy companies based on something called market cap. Luke, can you explain market cap?
Yeah, sure. So market cap is really the total size of the company based on what it's selling for on the stock market. So if a share of a company is selling for $50 a share, and there's 1 million total shares outstanding, that's a $50 million company market capitalization.
Interesting. If you've never heard that before, That's how they value companies.
Mhm.
And if you look at the S&P 500, the top 500 companies in the United States are the companies that are worth more than $8 billion. And a lot of times there's a couple more companies than 500, and sometimes there's less, right?
Mhm.
So they say S&P 500 does a benchmark, but the true number is like, okay, if you're over 8 billion in value, you can make it on the list. But up at the top of the S&P 500, you have large companies like Google, Microsoft, Apple. And at the bottom, you would have small companies like 5 years ago, Paramount was a company that was on the S&P 500. They fell off as Netflix kind of started to make the rise there, and all these streaming services came out. They tried to launch their own streaming service, and people were going to the movies less. It was just more convenient to go home, so they got kicked out of the S&P 500.
Interesting.
Yeah. So, that happens whenever that company's worth less than $8 billion. But it's like a hard rule. It's not like me and you talking. I'm like, man, Luke, I really think we should buy some Boeing today. We should really buy some Boeing stock. I'm feeling good. I'm looking outside right now. I see some chemtrails.
You feel?
I'm not going to say that. I can't say chemtrails. Anyway, that's wild. Conspiracy theories.
Okay.
I don't believe in chemtrails. I definitely have some clients who have said something. I actually had a client today who said something to me about chemtrails.
So that's just going over my head. I'm sorry. I don't know what that is.
Anyway, apparently it's the way the U.S. government's poisoning all of us.
Oh, okay. Interesting.
Yeah. Go down a rabbit hole after you listen to this podcast.
Okay.
You really don't know what that is? You've never heard?
No, I've never heard of it.
So
I live under
if
it.
you're listening to this right now and you have heard of like the conspiracy theories behind chemtrails, what I want you to do is pick up the phone. I want you to call the office and I want you to explain it to Luke
Okay.
today and just use up 30 minutes of his time.
Yeah. I'll wait for your call.
Yeah. Awesome. But anyway, I looked outside and I literally saw that. You see the streak of how the plane's flying through the clouds?
Yeah.
Yes, that's what the chemtrail
Oh, okay. I didn't know that.
is called. I neither could, I don't believe in that. Okay. Anyway. So, so let's say we look up in the sky and we're like, oh, there's, all these Boeing aircraft, I would need a telescope to be able to see what kind of plane that was in the sky. But, we decided today that Boeing was a good idea to buy. That, and then tomorrow, it's a good idea to sell Boeing, or, let's buy Lockheed Martin instead. But it's you and I developing our own opinion and then acting on that opinion on behalf of our shareholders. Now, at the end of the day, Wall Street has made a ton of money off of people like this saying, hey, me and Luke are the smartest people in the world. You should just give us all your money because we're going to make you way more money than what the stock market would make you.
Mm-hmm.
Like, yeah, is that intriguing if given to you by a charismatic person who like looks well, they're put together, they're in a nice, it sounds good. You're like, yeah, I want to trust this person. Sure, I'll give them money. But at the end of the day, 92% of these people fail to outperform an index fund.
Mm-hmm.
I'd rather show up in a sports coat, not a full suit. Luke's got a full suit on. We got a sports coat on, but it's Friday today. I'd rather show up in a sports coat and be like, hey, man, let's buy index funds. Like,
heck yeah.
I think my whole view on investment philosophy, and I know this is you too, is regret minimization.
Mm-hmm.
Like, I just don't want to be wrong.
Mm-hmm.
I'd rather our clients make what the market makes over the next 10 years and say, wow, the market averaged 12% over this period of time. My money doubled every 6 years. This was amazing.
Mm-hmm.
Like, I've almost quadrupled my money since I gave it to you guys.
And without taking huge outside risk.
Yeah. Rather than coming up to us and being like, hey, why'd you guys buy Ulta Beauty? And then you put a quarter of my portfolio into it, and then it went down by half and you sold it. Because you thought it was a bad idea by the time it got down to but it is baffling to me how many people do that and still buy into that model. But here's the worst part. People do it all the time without even knowing they're doing it by investing in mutual funds. And we've been talking all about hedge funds and why they're, not the best thing in the world to invest in. But at the end of the day, mutual funds aren't really much better. But Luke, can you explain, like, they can only put their money in a certain percentage of their best idea? So you do have an extra layer of security, if you want to say, in a mutual fund, but you're not getting rid of the fees, which definitely impact your overall return.
Yeah, that's right. Yeah, mutual funds, I mean, when I read Peter Lynch's book, and that was a while ago, he said that when he was managing the Magellan Fund, which was a mutual fund, the most he could put in was 5%.
Into his best idea.
Into any one best idea. So that does limit you to your best ideas. That regulation may have changed since then, but like overall, yes, mutual funds are active. Usually they can come with a long list of fees too. So typically you'll be overpaying for underperformance a high percentage of the time.
Awesome. Now, I believe a large part of what we do, Luke and I could go all day about why we believe index funds are better than mutual funds. All I would like for you to do is look up active versus passive management. And the large consensus will say, okay, this is probably a good idea. If you're a reader out there, I'm going to give you a plug for a book that's not actually my book. It's a great one, Trillions. It talks about the inception of an index fund, and it is a phenomenal read. So I would definitely look into that book. But I always want the listeners to be able to take away something from, and I was just thinking about this while we were talking about active versus passive management. I believe it's not only the impact that you have while you're alive, it's the impact that you have long after you're gone. That's what money does. You know, a lot of you listening to this are going to leave your kids more money than what you ever had access to. And you also don't want them to receive that money and be like, oh, this is the first time I've ever had money. Now I have to know how to act. The best thing for you to do is to teach your children and your grandchildren how to actually save and become wealthy. So Luke and I have just spent the last, 30 minutes talking about why index funds are better than mutual funds. And so many times teenagers and really smart kids will spend so much time trying to learn how to trade. Mm-hmm. And I think if they want to go into this field, that's a great idea. But let's say you have a kid who's going to be a doctor or a veterinarian or a EMT. I don't know why am I in the medical field right now? An engineer, okay? Mm-hmm. An engineer. If they're going to go and do something that has nothing to do with finance, the best thing you can teach them is how to invest in low-cost index funds. And when they actually have a money problem where they've created so much wealth, they're like, I'm kind of nervous. I don't know what to do with this. At the moment they get uncomfortable, that's when they reach out to a financial advisor. When they see so much money in their account that they're like, I don't know, like, I really want a second set of eyes on this. Mm-hmm. Because it doesn't take a crazy skill set to save $100,000, to save $500,000, to save $1 million. It takes consistency and discipline. And the best thing that you can tell your kids and your grandkids is to invest in their skills. If they're an engineer, become a better engineer, but invest in index funds along the way. If they're a doctor, become a better doctor, but invest in index funds along the way until you reach the point that you feel like you have a problem and you're like, ooh, I might have $100,000 tax bill at the end of this year because I need to sell some of this to go and buy a home. Maybe it's time for me to call a financial advisor. Mm-hmm.
Yeah, when that responsibility gets quite large and you may have that uncertainty, that's definitely when you need to come in and look for some advice.
Yeah, but I would say until then, teach your kids, unless they're thinking about going into our industry, which we do it all of the time. And the reason that we look into investment so much is that's our job. Mm-hmm. Like that is our responsibility. You know, I had a client today came in, they've been a client for 2 years, and they were like, Jonathan, I'm firing my advisor up in Michigan. I was like, that's awesome. I was like, Karen, what sparked this? Mm-hmm. And she was like, I didn't want to talk to all these people. Like I wanted to talk to one person. Mm-hmm. And you guys did a really good job with the portion I gave you to manage. And I was like, that's really good. She said, I've slept better in the last 4 days before I got here. We hadn't even had our meeting yet. Just whenever I made the decision, I'm going to move all my money here, the peace of mind that I felt was, I felt like a huge weight was off my shoulders.
Amazing. That's what we love to hear.
Yeah. And I mean, you're sitting up in the front of the office and you hear her talking to Mari and just like, she's got this positive, ultra positive outlook on where she's going. And I believe you can get there when you find the right person, when you believe in the right advisor and you invest with the right advisor. But, yeah, I mean, it's so cool. I love what we do.
Me too.
I love giving back to this community of people who, I had another client yesterday. I think I told you about this. They said that we listened to your AI podcast twice. And I was just like, man, Luke and I just, somebody gave us a second listen. Like, that's awesome. You would not believe the feedback that I love hearing.
That's pretty cool. Like I love that.
But it's the time that we put into it, and we're like, hey, today we're going to try to bring value to our crowd. So I want to commend you if you're listening to this right now. You're on the right path. Always have the white belt mentality. And remember what I said about your kids and your grandkids. Tell them to invest in their skills and invest the money they make from their skills into low-cost index funds. And they're going to have a money problem in the future. And the best thing in the world is they're not going to have a mentality problem or an emotional problem when they inherit all the assets that you're going to leave to them. They're going to be prepared and ready to handle that and be a good steward of that money. So thanks for listening to this episode of Build Big, Live Bigger. Luke,
Put it there.
appreciate it, man. I'll see you guys.